we are here just talking about wealth, preservation of wealth. You know, that's all I talk about is preservation of wealth. And so, you know, Tony, you are a insurance broker with several companies. You have a lot of different insurance agencies to walk through. I'm going to let you introduce yourself. I met you about a month ago now.
Yes.
And what I loved when I met you is that you knew what I was talking about when I said, I want, as a real estate investor, to put my real estate inside of an insurance vehicle where, it would be protected. And I've spoken to different people about it. They call it different things. They call it infinity banking. They call it, just these different universal life. I learned initially about certain insurance policies recommended by Tony Robbins from the book Money Master the Game. Mm-hmm. And he talked about a universal life insurance policy, and he gave a lot of details in that one. Since then, I've run into different types of insurance brokers and agents that have said, hey, do this. We have this IUL, which is the Index Universal Life policy. And, you can put your money into it and then you can borrow against it. I have spoken to several people who said they can do it, but I had never spoken to anyone who has done it. Recently, I've met several people who have, and I ran into you, and I'm so happy to hear that your focus is real estate investors. That's your main focus.
Yes, that's 100%. That's my main focus. And maybe I can give you a backstory about, who I am, where I come from, to kind of give you a picture on how I ended up helping, all the real estate investors. So I'm an immigrant. So I don't know if you guys noticed the accent. I'm originally from Kenya. So as an immigrant coming to this country, most of us come to the United States for American dream, right? You want to, come to the country and prosper, a land of opportunity, right? So when my parents and I got here, one of the things that I noticed is a lot of immigrants coming to this country, they never get to achieve the, financial independence, the American dream. So I was always curious about money. I was always curious about how it works. And because of my curiosity, I just ended up landing into the financial industry. So I went to school. I'm in California. I went to school to learn computer animation because that's my goal, is to eventually start my own movie industry, my own movie company. But I needed money. I needed to get money to get to that goal. So my curiosity about learning about money led me to meeting a gentleman in the financial industry, really knowledgeable when it came to life insurance, retirement planning. So we specialize in rollovers and those types of plans. So it was my last week of school. I was taking a finance class, didn't learn anything. I took an economics class, didn't learn anything about personal finances. It was mostly like, okay, this is what we do to calculate numbers, to help the company, bottom line. It wasn't about personal. Like, I didn't know what a mutual fund was at 28 years old. I didn't know what a mutual fund, how it works, a 401k. And this was around that time when the market wasn't doing so good. And so,
I have a question. So the country that you come from, what country did you say?
Kenya. I come from Kenya.
In Kenya, are those vehicles a thing in Kenya?
So I was 14 when I came to the country, but what I know and what I remember is my dad has a pension plan through his company. And we all know a lot of companies now do not offer pension plans because they cannot afford it, and a lot of people are living longer, so they cannot afford to pay somebody for the rest of their life after retirement. And there is life insurance, but when you come from a third world country, you don't spend money on life insurance. The main focus is a roof over your head, food and clothing, right? The basic necessities. When I came here, I realized our parents and my relatives and people who come from those countries, that has been the same mentality. So it's been really difficult for me to tell them, hey, you know what? You're in the United States. We got to now have these vehicles because back at home, you work for 10, 20, 30, 40 years, you get a pension, you get to retire for the rest of your life. But in the United States, a lot of things are purchased on debt. So you got to purchase that life insurance policy so that it can pay for all that debt, you know what I mean? Because when a breadwinner passes away, you can't really, you can't replace the person, but you can replace the income that person was bringing in. So that's why it's important to purchase the policy for that.
I'd like to stop you just for another second. You said you need an insurance policy to handle all of that debt. Help me understand that. That was an interesting statement there.
Okay, this is some education for the group here. There's an industry standard on how you calculate the amount of insurance that you're supposed to have. So the acronym is called DIME. So D is debt, I is income. What you want to do is income times 10. M is mortgage. E is education or expenses. So you add up all those numbers together, and that's going to give you the amount of insurance you're supposed to have, the amount of coverage you're supposed to have. So a lot of people, like when I would be meeting with clients, they told me, hey, I have 100,000 in life insurance coverage, but I would tell them, okay, your home is worth $500,000. Your job, you get paid six-figure income, so that means you're supposed to have like 1.5 coverage. So
Right. So most people are completely undercovered. They
you're
don't
undercovered. So that's a way to calculate, dime and then expenses, right? So initially insurance, we just use that to be able to cover that breadwinner. So if something was to happen to them, their family is taken care of for the rest of their lives. So in the beginning of my career, that's the product I was selling. So as I was getting more seasoned, I've been in the industry for 10 years.
Now,
So
let me ask you a question. Let's say, I'm sorry to keep stopping you,
oh,
but
no, go ahead.
yeah, I just want to hear your point of view on term versus whole life.
Okay.
So if you have a term insurance policy, for some of us, we learned, that have been in insurance for a little while, the term life insurance policy doesn't build up a cash value. So that means that you are, instead of buying, say, 1.2 million, does DIME work for term and for whole life, or does DIME only work, or one or the other, or either?
Yes, that's a great question. So there's and DIME does work with term policies. So there's two types of life insurance policies out there. Regardless of all the names that we hear, there's only two types, right? There's permanent life insurance and there's temporary life insurance. Permanent life insurance are the policies that have cash value, like your whole life, your universal life, your index universal life, your variable universal life. So all those policies are considered permanent. Temporary life insurance is a term policy, and that's the least expensive policy. You're just purchasing pure life insurance. So in example, when we purchase a home, right, and we get that mortgage, let's say we get $500,000 mortgage, and for those people who are experiencing this, that purchased a home, they get those mailers, right? Hey, mortgage protection plan, a 30-year, right? So that's essentially what that's a term policy.
Oh, wait. So that mortgage, that insurance, because actually, to be honest, I don't remember getting those before a few years
ago. Yeah.
I felt like this is a new thing because the last 3 properties that I bought, you're getting these mailers everywhere. Buying insurance against your house. And that's a term life insurance?
That is a term of life insurance. You notice with terms, you get a 10-year term.
Is that a brand new policy though? Is it something new that came
recently? No, it's been around. It's been around.
For some reason, I just recently started receiving. I'm talking about the home warranty. Is that it? Like the home warranty?
No, I was talking about the mortgage protection plans.
Yes, that's it. Mortgage protection.
Yeah. Mm-hmm.
So mortgage protection plan, they're just only trying to sell you a term life insurance policy.
Yeah, and then also you have to realize in the industry, they use a lot of marketing terms, so it confuses people. And they use it to make people think, oh man, this is a new thing, I better get this thing. It makes you feel ahead of everyone else. But that's what it is, and that's why I was mentioning to you earlier is if you hear policies, for example, they call it family banking or self banking, or all it is just permanent life insurance. Yeah. It's all the same thing. It's just that and in terms of differentiating what type of policies are, that may be something that somebody might want to know, because it's kind of like the cell phone industry. If somebody is selling you on a Nokia because of how durable it is, right now it's 2023. People are on iPhone 14. You know what I mean? So it's either you want to. The Nokia still works. Whole life still works, but the index universal life is upgraded of a whole life policy. So I just love to keep it simple. I use analogies just because there's a lot of marketing that has to be done to sell these products. So
why do you think it's such a big deal to market? Why do people not want to buy insurance? Like for why is there so much marketing? Do you have any idea?
In terms of marketing strategies, there's so much of it. Number
Why is it just because of competition in general, or?
Like policies pay really well, right? To us agents. Another thing too, the reason why agents are being creative and clever in terms of marketing terms and stuff like that is because our industry is highly regulated. So we can't just say life insurance because Uncle Sam is not getting a cut out of it. Life insurance is a non-taxable vehicle, so we have to be really careful on how we market it because Uncle Sam is not. It's a non-taxable vehicle. A lot of wealthy like to use it to secure their money.
And now we get into preservation of wealth.
Mm-hmm.
Now we start talking about how insurance can be used to preserve your real estate. You talked about Dime. Tony, I feel like we have a lot of viewers with us here on Instagram. And if anybody has any questions, please go ahead and put it and let us know what your questions are so Tony can answer. But what company are you with? And could you give us, I know about your personal background coming from Kenya and being an immigrant, finding an amazing mentor that helped you get to where you are now. How long have you been an agent and how long have you been serving the real estate community?
Okay. Yeah, that's a great question. So I've been in the industry for 10 years now. I'm with World Financial Group. I'm independent in terms of the carrier. So I have access to companies like Nationwide, Prudential, Pacific Life, you name it. I have the power of choice, so I can shop around, find the best companies that would fit the needs. Because there's some people we just won't qualify for the plans based on age, health background, you name it. So I give that extra white glove service to where I can be able to shop around and find a company that would accept somebody.
And now, why did you start focusing on real estate though?
Okay, so what happened is when I was so my demographics before was all over the place. It was everybody, right? It was like construction worker, nurse, you name it. And what happened is because I was all over the place in terms of my target market, when COVID happened, there was a lot of people that would drop their policies. They would cancel their policies. They would not give me a call. And and I have a different understanding of the policies now because of the market that I'm selling to. When you talk to the higher income earners and explain to them about how policies work, they understand the product. Their parents probably had it, and it's an easier sell. And for me, as an agent, I also have a business too. I want to make sure that my clients actually have these plans and they keep it long term. So I was thinking, okay, maybe I can go after the medical field. So I started going into the medical field. A lot of them were mentally checked out to pay attention to the product and see how it works because of COVID, nurses, the hospital facilities.
You were trying to concentrate on doctors.
I was like, I wanted to help them.
I've been listening to you.
I wanted to help that market.
Life insurance right now when everyone's dying or being told that they're going to die at least.
Because I was thinking, man, and COVID was actually, it worked out to raise a lot of people's awareness because they're like, okay, I need to get my stuff in order. They started thinking about life insurance. They saw their 401ks and retirement go down to the dumps because of the market situation. And so I was like, I want to show them how the policies work. If they put money, the market crashes, if they're not going to get affected because of the index strategy. So this is a little bit product knowledge. So I started looking around. I was like, okay, I needed somebody who's money savvy, who wants to grow their money, who understands how money works and would love a tax-free advantage, like non-taxable vehicle. So I was like, oh, real estate investors. So I started, so 2 years, I started interviewing and talking to a lot of real estate investors. I started learning about the sub niches, fix and flips, buy and hold, multifamily, wholesaling, commercial, residential. So I was like, okay, let me go. I love multifamily because I'm like, okay, they have a property that's giving them a constant cash flow. And remember, all my clients were dropping from the ones that are, COVID and all that stuff. So if somebody has a multifamily and they're getting that cash flow, they can use that cash flow to fund their policy. And it's going to give them a vehicle for a non-interrupted compound interest. And they can be able to leverage it. If they want to get more doors, they borrow money from their policy and they put it down.
Okay, you dropping the dimes now. You dropping it now. Now we're in the weeds. Now we're in the weeds. You can't just say that fast.
I got to slow it down.
Now you're talking our language.
Slow it down for everybody.
So you said, now you could take the cash flow from the multifamily properties, because obviously large multifamily is paying you. You're buying income. You're not just buying a property and getting one paycheck or buying one rental income where that one house or even a 1 to 4 family, you got 2 or 3 incomes. Now you might have 100 incomes or 400 incomes. We're working on a property right now. It's 673 doors, and it's going to bring in to our investors $6 million, just over $6 million a year. So now that's $6 million in net operating income per year. What is it that you're saying can be done with insurance?
So this is the cool part. So that cash flow that's coming from the multifamily, you have it go in your policy, and the policy starts growing, uninterrupted compound interest, tax-free. It's a tax-free vehicle because it's an after-tax dollars that's going to come from.
Stop on the uninterrupted compounding.
Uninterrupted compounding.
Uninterrupted compounding.
So uninterrupted compounding is when it's sitting there in the policy, year by year, you're earning interest. So nothing is interrupting it. You're not dealing with the volatility on the market. It's not interrupted by anything in the market, because it's an index strategy. It kind of works like a staircase.
Talk to me about that. I'm gonna break it down now. Okay.
Oh, yes.
So the index and the staircase, could you break those terms down, please?
Okay. So when we put money in the market, what's the worst thing that could happen to our money?
That the market crashes like it did in 2020 and everything goes to like 20% of its previous value.
Oh, and then what's the best thing that could happen in the market?
The market goes completely up and all the stocks go to 100% of its previous value.
Yes. So with the index strategy is, so let's say this is your money and this is the index. So the market goes, this is the market. So the market goes up, your money goes up with it. If the market crashes for whatever reason, COVID, wars happening overseas, you're locked in the gains and you don't lose money that you have in there, right? So you don't participate with the downfall of the market and you're always like ratcheting up like a staircase. So the cap, so I know a lot of people might be asking, so what's the cap and what's the floor? So one company that I love to use. No,
but you know what? The way you just explained it, because I asked you what's the cap and what's the floor.
Oh, okay.
I know I had asked you, and we're going to go over that with our viewers. However, the way you just explained it showed me that the floor didn't matter because you are locked in.
You're locked in, yeah.
You're locked in, so you won't lose any money. Either you make money or you make money.
Right. So, and then it also goes down to like people understanding of the market. So if I had $100 in the market and the market fell down 50%, for me to go back to $100 the next year or whenever, the market has to go up 100% for me to go back to where I was in the beginning. Mm-hmm. So most people don't understand that when it comes to the market, when we lose, for us to get back to where we were in the beginning, the market has to have an extreme drastic gain, which in the human history, we haven't seen those kinds of gains, right?
I mean, we've seen a 20 or 30% gain. We did see a huge gain and a huge comeback after COVID. So we did.
For it to go back to where you were originally started out, the market has to do 100%.
100%
return. Especially after we lose 50%, we're at $50. That means you go 100% rate of return for you to be at 100. With the index, you're not going to go down. You're just going to start from there and keep going up. And as a matter of fact, during the crashes and the floors, the minimum is 0.75. So you're also getting a credit even when everybody else is losing -20 or -15 or.
Now you know what I thought that meant on the floor, because I was telling you that I had checked out this kind of policy a few years ago. And I mean, it wasn't even that long ago. I think it was 2016 or 17 that I was in a meeting, and they said that the floor at that time was 4%. But I understood it to be different than what you just explained. I understood it that you would not lose more than 4% of your money, but it's not that. It's that you would make 4% or the ceiling. And now it's 0.75. So there's 0.75. So that means that no matter if the market crashes like it did in COVID and your money is in this vehicle, your money didn't move. It's bottomed out and you're still going to make 0.75, even if the market's crashed, no matter what vehicle, what index is in, no matter if it's an S&P 500 or whatever index.
And that's the index strategy. And then the cap, it's 13%. You know what I mean? 13%.
Now, when I looked at it, it was 15.
Yeah, so, the numbers change. Also, these numbers change all the time. When you get grant, because I have policies on my own, my policy is locked at 15% because I was like, everyone's like, I need to purchase it while it's 15%, but they change based on the economy.
Right.
Same thing with the products. So the reason why, especially a lot of people in the marketplace, they hear all these different names. These products also go through changes based on what's happening in the economy. So prior to 2008, 2007, when the market crashed, the vehicle that was really popular were VULs, variable universal life. Now, variable universal life after the 2008, those products don't do really well, but they used to do really well prior to 2008. So if somebody's like trying to sell you on VULs right now, it's like, okay, no, this vehicle is not good based on where we are in
now, do the products do well in different markets because of what the agency decides to invest in? Like, I know that the index, like for instance, we know mutual fund until, you get the prospectus and it tells you which funds it's invested in, or if it's an index universal life, then it'll tell you like which indexes it's invested in. With the variable life, is it invested in a different product? Because I know that certain insurance policies may be invested in bonds, it may be invested in different things, right? It's not always the stock market.
Yeah, 100%. And also, since a lot of these vehicles are mirroring the market, they do well based on market conditions. So, and then, the times have changed. Like years ago, we didn't have cryptocurrencies, and now cryptocurrencies are here. And now they're having products that are based off of those vehicles.
Even in insurance? Oh.
Yeah. In terms of like the mirroring, we use a lot of index, like the S&P 500, the Hang Seng. But mutual funds now in the industry, they're using cryptocurrency as their backing, which is like times change, but we as agents, we have to keep up with the times. We have to make sure we do the best for the clients at that particular time. So want to make sure that, especially with these products, I know I can take $1 million from a client and my commission will look really nice. And that's also the reason why I'm getting into the real estate niche, is because my commissions are really, really nice.
I'm sure, especially if you've got someone with a multifamily, like we have a fund. I'm going to have to speak to our CPA and see how that would work. But I think it's something that we definitely can recommend to our limited partners to be done. And what I love about what you're saying so far is 13% on the cap. And so do you, as far as that 13%, I know for a fact, if you can get your money to do at least 10%, sorry about that. I know for a fact, if you could get your money, someone called and it messed up the Instagram. Waiting for that to come back. Okay, we're back, guys. Sorry about that. Someone called me. So if you could get at least 10% return on your investment, no matter what. So let's say you have $1,000 and you could get at least 10%. The rule of 72 says that you would basically double your money in 7.2 years. So that means that you're doubling your money quicker at 13%. And of course, that's the cap. That's if we had the next several years of excellent, excellent income. So that's just how much money you can make, how you can compound. Thank you for explaining that. However, how are we preserving our wealth? So it's because if it's in an insurance vehicle, obviously you're not able to use it unless you get a loan against it. So the other thing that we know as far as preservation of wealth is, there's two things when it comes to multifamily, and I want to know how you're addressing this because it looks like it's a double wealth protection. Number one is that with multifamily, 100% depreciation. If you do a cost segregation analysis, you're able to depreciate the 27 years in day one. So that means that you wouldn't pay any taxes, and that actually 100% ended. It was a special program that they implemented for COVID that actually had ended, not completely, but they're phasing it out. So they're phasing it out. So this year it's 80%. So you can write off up to 80% of your depreciation. So that means we're able to pass on that kind of waterfall to our investors. So that means that our investors are able to get the depreciation. So they're only having to pay when they get their check in the mail. They're only have from that net operating income, say for the 6 million we talked about on that complex, they're only having to tell the IRS it's it's depreciated because of X, Y, and Z. And so I think you're only having to claim 20% of that income. That's huge. Last year was 100%. That's huge. So let's say you went and you put your money into this insurance vehicle. Now it's protected. Talk to me about the preservation of the protection as far as from lawsuits. And we have another wealth preservation call we're going to do tomorrow, where we're going to talk about trust with a #1 best-selling author. She's going to come. Her name is Chris Miller, Kris Miller. She's going to be coming and talking to me tomorrow at 6 p.m. Eastern Standard Time. And we're going to talk about trust because, Tony, I said I was going to talk about trust with you. But let's just stick to insurance. How are we preserving our wealth? We know that debt also, you're not taxed on debt, right? So when you borrow money, you're not taxed. Like someone was telling me earlier that they wanted to sell their house to get the money out of their house. And I said, don't do that. Do a home equity line of credit. And you can use those funds to go and buy more property. And then you rent that house out. Don't sell it. And so, and they got it because now that money, it didn't go in cash. So you don't have capital gains. Talk to me about those things on how insurance protects us as far as the preservation is concerned.
Yeah. So I was designing this. You can tell we're busy people when we can calls when we're doing this thing. So there's two things that eat up our money. And if we have a pile of money for retirement, or we have a pile of money that we want to use for future investments, there's two things that eat up our money is taxes and the market. So taxes is one thing. Life insurance is a non-taxable vehicle. So if you were to get those rate of returns in a policy, you're actually getting to preserve a lot of money within your family, because a lot of that is going to go to your beneficiary, right? Another thing is life insurance is a non-taxable vehicle. So that means if you put after-tax dollars in there, and let's say it grows and grows and grows, you can be able to pull it out tax-free to be able to use it for retirement, use it to leverage it tax-free. So, in terms of
putting after-tax dollars.
You're putting after-tax dollars, correct. So it doesn't work like a tax-deferred vehicle like a 401k or a 403b. Another thing too is if you look at taxes, because wealthy love to know all about taxes, right? So if you look at all these tax vehicles, right, like 401ks, 403b, 457, 529, all these are tax codes. These numbers are tax codes. So if you go to the IRS website and look up 401k, it's going to give you a description. It's kind of like a different language, but all it is, it's like a description on how that particular vehicle is taxed. And the tax code behind a life insurance policy, the ones I offer, is 77028. That means after-tax dollars that you put into this vehicle, you can pull it out tax-free for future use. That's why a lot of wealthy love to use these vehicles. The banks use it, senators, anybody that has big money, they use these plans because they know the tax codes, they know the tax laws behind that, how that particular vehicle is taxed. So that's why they take advantage of them and put as much money as they can as possible in that. And it's 100% tax deductible. So you might want to talk to your CPA accountant and see how you can take a certain amount of money and you dump it in there. So because a lot of people have money in accounts that is in bank accounts and so on, right? Somebody can just go in there or slip in your property and sue you, right? So
okay, talk about to that. Is there a protection against lawsuits and debtors?
Yes. So when you have money in your life insurance policy, nobody can go in there.
Creditors, not debtors.
Creditors and predators. So when you put
predators.
Yes, when you put money in a life insurance policy, what happens is you're putting protection around your money. Just like if you were to purchase an expensive $500,000 car, right, a Rolls Royce, you want to buy car insurance to protect that car. So if it was to get wrecked or whatever, you have the insurance value of that car to be able to purchase a new one, right? So same thing with your income, right? You want to protect your income with life insurance, and so it protects us against the IRS, it protects it against the court system, and it protects against bad people. The only person that has access to this money in your life insurance policy is yourself and your beneficiary. Right?
Now, what about child support and divorces?
Divorces, yeah, it protects against all that stuff. So the only person, because it's a contract, right? Life insurance is a contract. If you're the owner of the policy, the written document that this will go to the beneficiary, right? Because you're going to write down the name of the beneficiary. I wanted to go through this person. And then you had mentioned a little bit about the trust. So a trust is a written set of instruction on what to do with the life insurance money. So let's say you want to leave this $2-3 million to your 18-year-old, and your 18-year-old might be a knucklehead, right? They might go want to buy some rims or a Tesla here in California. what you do is with the trust, it's a set of written instruction on what to do with the life insurance. Maybe you want them to get 50,000 a year until they deplete the $1 million. Maybe you might want the agents to give them a policy with this 3 million that you left them. So it's just a set of written instruction, and if your audience is actually working with somebody, an attorney that is setting up these trust plans, how it's structured is, and I know some of the people that you work with have LLCs or S corp or C corp. So that would be the corporation would be the payer, you as the owner, you're the insured, and then your trust is the beneficiary, and that's how it's structured. Corporation is the payer, the owner is the insured.
So my understanding though is that insurance, and I think most of us believe that insurance is for retirement planning. No, actually for death planning. How is it for retirement planning, and how how can those funds be used right now for lifestyle, and not just being put into this vehicle? Is this only for retirement planning? Actually, let's go one at a time. How is an insurance policy for retirement planning?
Okay, so what I do is I just reverse engineer a retirement plan with them, and I design their policy specific to that goal. So prior to helping people in the real estate niche, the real estate market, I would design it mostly for retirement. So because mathematically, if you look at 401ks, based on how the market has been doing, that vehicle hasn't really performed really well. As a matter of fact, no one has ever retired with a 401k plan, and the Social Security funds are depleting, and it's said to deplete by 2037. It's no longer.
I've been hearing that since I was young, that there was going to be no money. And
COVID elevated that. COVID actually, a lot of people retired.
I think the money's big on. I've been hearing that since the Clinton days, but I think because especially we thought that by 2011 that was going to be it. In 2011, most of the baby boomers started to retire, and it was like 33,000 people per day or something by 2011. So we thought for sure they were going to run out of money. What I think they are doing is they are taking all of the new people that work and they're paying the older people.
Yeah. And then also,
I think there's no money in there. There hasn't been. I mean, if you just look at the budget, you can, on the White House, you can see that.
Yeah, and then also the people no longer have pensions. So guess what? It's their personal responsibility to design their own retirement, to set money aside for that goal. So you had asked me about other goals. Yes, I can customize the policy for whatever specific goal that they want. Whether the
policy can actually pay you when you're, even though you're not dead.
Yes. That's they call it life insurance because you can use it while you're still alive, right? It's not.
No, it's not right. I didn't know that. Let's talk about that. And I remember I had my Series 6, 63, and 7 once upon a time, and I only knew about the death benefit. That was over 20 years ago. Talk to me about how you can use that vehicle to make payments for retirement.
Yeah. So for retirement,
I know that you can borrow against it. Okay. Yes. Are we talking about borrowing against it, or is there something else?
So yes, you can do there's a number of ways you can pull out money. So
and then I know about annuities, but we're not talking about an annuity. We are talking about something else. We're talking about a universal life insurance plan. So I wasn't aware outside of an annuity or borrowing money that there's another way. Is there, or am I in the ballpark?
Yes. So I'll kind of I'll give you an example on what I've done with my clients. 2 scenarios, one with an annuity as well. But with the life insurance, you can design it for whatever goals that you want. If somebody wants to save money into it to purchase a home in the future, or they want to use it for college savings, so I'll just do it for retirement. So what I do is when I sit down with a client, I ask them what's the income that they would want for during retirement. Is it $8,000 a month? So I tell them based on that retirement goal, I would do the math. 8,000 times 12, it'll give me 100,000, and then I would tell them, okay, you need an account that you can pull out 100,000 from. So based on that, at that age, you want to have at least $1 million saved in your life insurance policy, so that you can be able to live off of the 10% or whatever percentage that is enough for the living. So based on what I do is I kind of reverse engineer it. Based on your goal at 65 of you being able to pull out $8,000 or 100,000 a year, you need to have $1 million saved in your policy. So what I do is I would start the premiums with them. Let's say they can comfortably set aside $1,000 a month or $1,500 a month. They do that on top of, so when you look at an illustration, the policy compounds and grows. You have the cumulative value. This is all the premiums that they're putting in, right? the $1,000 a month or $1,500 a month. There's a cash value, which is the cumulative plus the interest, which is the now compounding, right? So there's two values, right? And then and the third one is the insurance, the coverage, right? So let's fast forward, they're 65 years old, they're gonna start pulling out money, right? And you know with interest, right? If their account did 8% and they don't really need 80,000, they don't need to pull out 80,000. They just pull out whatever they need and let the rest compound in there. So let's say it did really well. So 65, they accounted 8%, for example, they can pull out 80,000 and use that for their living.
Is that 80,000 now pulled out as a loan?
So first of all, it's gonna be pulled out from the cumulative value first, and that's not a loan. That's just a withdrawal. So all those premiums,
okay,
all those premiums they put in. First of all, they're gonna take it out of this one. Let's say it's total 300,000, and it grew to $1 million, for example. So that 300,000, they're gonna start pulling that out first. When this 300,000, all the premiums deplete, it's called cost basis. We use life insurance terminology. So all these premiums that they put in, once this 300,000 depletes, then you're gonna start pulling out a loan out of the cash value side, which is their interest. And then,
so which increases more, the cumulative or the cash value?
The numbers, the cumulative is just the cash without the interest. So when you look at an illustration, it just shows you this is the premiums that you're putting in.
So the cumulative is all the money you physically put
all the money that you put in.
And you can take that money out at a certain time without any loan.
So that's how, that's exactly true. That's how I designed it with people. So we literally sit down and figure their retirement out. Nobody really does this at HR department. They're not licensed to do this. Nobody really sits down, because this is the stuff I wanted to learn as a curious 28-year-old. I wanted to know, how does retirement work? And my mentor told me, retirement is not an age, it's a pile of money you can live off of for the rest of your life. So I designed this policy to where it's creating a money tree for them, and then they can now live off of the fruits for the rest of their life. And the fruits is the interest, right? You don't want to chop off the tree, right? You don't want to cash out your life insurance and go buy a crazy purchase. Right. You want to live off of the interest that this money this money tree is making you. So with a retirement, really, you take out the cumulative, which is all the premiums that you put in. Once that depletes, then you start taking out a loan. And if it's designed right, this can go up to 100 years old. You know what I mean? They can pull out money until they're 100. So when that's the reason why I wanted to go into the real estate investor niche, because I know that people are a little bit money savvy. And so if I tell them the numbers and it makes sense, then they're like, okay, now I'm going to have a retirement because it's clear. But when someone comes from a working background, they're told what to do. They're not go-getters and stuff like that. It's a lot harder, because when they sign up for a job, they're given a 401k.
If you think that's bad, you are so right. I had someone call me, a friend of a friend, and they said, Tene, this person has $11,000 and they want to invest it. What can you do? And I said, you mean 110,000? And they were like, no, $11,000. I'm like,
yeah. Or I had
okay. Oh, get this. It's a crazy story, because I'm surprised what happened next. So I spoke to the person and they go, well, I have 15. And I said, okay. I had to think about it for 2 days before I called them back. Like, what can I possibly do to help you? So I said, okay, here's what we're going to do. $5,000, we're going to look at some tax liens. That tax liens in Texas specifically pay you 25% interest every 6 months. We'll find $5,000 worth of tax liens in Texas. That'll get you 50% on return on your investment in a year. You can just keep flipping that as many times as we can. Then second thing we're going to do is I'm going to help you find a distressed owner where we could just pay them to leave for $5,000 and we'll get a rental. Last $5,000 you got to pay me for my service is $4,600. Do you know that this person said, I got to think about it, because if I pay you the $4,600, I won't have any money. I said, I'm done. That's it. I don't even want to talk to you about it anymore. Because if you didn't just get what I just told you, I don't want to talk to you anymore, because you're going to be a headache for me.
So that's what I realized too. In business, you got to sell to the right market, and if you get it, it's a smooth process if they understand how the product works. Because for me, that was my thing. I was trying to explain to people how this would work. It's like, look, you lost 45% in your 401k. It's taxable. It's a tax later. With the way the economy is going and $30 trillion in debt, you think the taxes are going to be lower or higher in the future? It's going to be higher. This is a deferred vehicle. They're now moving the required minimum distribution into these plans to 73. You know what that means? People are going to be taxed even more because they're going to be in a higher tax bracket. those couple of years is going to mean they're going to have a little bit more money into their accounts. They're going to even be taxed even more. So it's all by design, and it's just that we got to design it for ourselves now, exactly, down to our lifestyle. It doesn't matter. Even for me, it doesn't mean that, well, people who come from working backgrounds, like their mentality is, I don't want to sacrifice my lifestyle to be able to put money aside. But when I talk to investors, they're like, okay, I'm going to do a couple of deals, make a few more extra money and set it aside. So they're still going to travel, they're still going to have fun, they're going to party, but it's a different mentality about getting the money to, their favor. So
Your
that's why
money has to work for you. I love everything you're saying. You are the most perceptive insurance agent I've spoken to, and I promise you, I've spoken to a few. I've had this conversation at least 3 times a year for a few years.
Oh, okay.
And I'm always very concerned about the understanding of the person I'm talking to who just became an insurance agent a few months ago. They went to a meeting, and they just became an insurance agent. I'm like, you don't know what you're doing. I can't afford to mess around with you because, and I've spoken to people. Recently, I've spoken to someone that I met at a very big family office meeting with nothing but wealth advisors there. And when I asked him about this IUL and about designing the plan so that you could be able to, now we didn't talk about it yet, but how you can overfund the vehicle and then use those funds to buy property. Let's talk about that. And then, I mean, we don't have to, we could do another meeting because we've been on here a minute. And I could keep going. Hey guys, does anybody have any questions? We've been going for a minute. And let's see, it's almost an hour we've been going. Does anyone have any questions? Because we have been hitting hard. I mean, Tony has just been killing it, right? That's Tony. There you go. All right. And he has just been killing it. I mean, for real. And he works with investors. And this is the part that I love, is that he works with real estate investors. Tony, we've been going a whole hour. Do you want to answer that last question? Because we love what we do when we can talk about finance.
Well, I can talk forever about it. I can talk
about finance for an hour. You gotta love what you do. But all it is knowing that you can make money and then trying to figure out how everybody's not in your pockets. I love what you said about protecting your money from the creditors and the predators. If you guys just popped in here on Instagram, you're going to want to rewind this because Tony has dropped some gems, and you can tell he's doing this. He's not thinking about doing it. He didn't read the manual. He didn't get it. This is what he is doing. So, he at CEO _Tony Opee, OPEE. We wanted to do this live stream this way. For those of you on Facebook, he is Tony Opee, Tony Opee on Facebook. Do you want to drop your number, how they can contact you?
Yeah. Because of Tene, I'll give you guys my personal cell phone line.
This is recorded, so you want to give it here?
Oh, no, yeah, I'll give it here.
Okay.
Personal. This is my personal cell phone line. It's area code 408-442-9993. Shoot me a text and let me know where you found me. If you saw me on here, and shoot me a text. Say, hey, I wanna design. I'll help you. I'll put together. I do customize. I customize to your goals and dreams, and I also push people. I tell them, hey, you gotta make more money. And so get with Tene, find out what she's doing. Let's get that money up.
I am so excited to have met you. We've been kind of back and forth. And to be honest, I can hear people talking the talk, but they're not really walking the walk. You said something in here about, hey, I got my own policy. I grabbed it at 15%. And I've been looking at this because I was able to tell you it's 15%. And it's when I sold my last property in December 21. I had some money then, and I was trying to figure out, I had someone in my ear about doing an IUL. I have an IUL, but I bought the wrong one. So I bought one through MetLife because after I read the book, Money Master the Game, I went and bought an IUL, but it was the wrong one. So I've just had that policy knowing that it was the wrong one because I keep hearing them and then I knew someone from World Savings as well. That was, and I asked, and I like to watch people. When people talk, I'm 40, I just turned 49 over the weekend. And when people talk, I will literally watch you. And there was a few years that there were several people within my circle of influence that were saying, take 50,000, take 150,000, put it into the IUL. And it was so much hype around it that I just said, okay. That was around 17. That was when I was telling. So I checked all those people again, and none of them are insurance agents anymore. Yeah. And none of them are even focused on insurance, and no one's even talking about it anymore. Now, how could that be possible unless you just hype? So, so that's why I just kind of watch, because some of these things go in cycles. They go in cycles, and some people are just yep. And, and you watch them and you watch the hype, and then you can tell that it's hype. And they're just trying to get you to come in and bring their money so they can make a quick commission. And they don't even know what they're doing. They don't know how to design a plan like what you're saying. You're telling me, and I can hear the experience. I can hear that this is what you're doing daily.
Yeah, I approach everything for the long term, even how I build my relationships with people, business, or even with my agent, and I realized like people love the trends. And I would be meeting with a client and I would share with them, hey, this policy has been around for hundreds of years, right? Insurance has been around for hundreds of years. Yeah. And I like longevity. I like certainty when it comes to money and retirement, because these people are going to be living off of this money like, 10, 20, 30 years from now. So, and then I would be meeting with somebody who's like, oh, I started investing with cryptocurrency. I'm like, no. We don't know about that stuff. I mean, I'm not going to, downplay it or whatever, but I always understand that you want to put money for retirement aside. You want to put gambling money. You can play with that stuff. You can also have fun money. But I want to make sure that let's not play with retirement money. Let's keep it safe. So and for me, it's like it's all about that. And people are excited about one thing today, and then tomorrow, hey, what happened? You were telling me about this. What happened? I'm not doing that anymore. So exactly. I understand being in this industry, you got to build a name for yourself. So I've been doing this for 10 years, 2 years in the real estate investor niche. I've gone as far as building relationships with the presidents of the companies. So I don't even call the regular 1-800 number an agent would call. I call the number that presidents of companies call. So because my niche market is I want to work with high income earners.
You're bringing them a lot of money. So they're going to take your call.
Yeah. I want to work with high income earners. So I heard about this term, the white glove service. My clients love that. They love the fact that, you know what? I was frustrated, like for me, I was frustrated. I'm calling customer service and not taking care of my stuff. Who's the president of this company? Let me call them. You know what I mean? So, and they would be on it. I mean, I
am going to post this live. Thanks, Tony. Thank you for the happy birthday. Someone said, am I going to post this live? Yes, I'm going to save it. We've got so many people that chimed in, because I focus on, wealth, obviously, and real estate investors and so this is the thing, and so we're recording live on Facebook. Hello, Facebook. Let me